Let's bring in Robert Sinche, head of FX strategy for the Royal Bank of Scotland. Thank you so much for coming down from Stamford.
It's great to be here.
It's the ultimate sacrifice to have, even on a Columbus Day. Was it slower because it was Columbus Day?
No, the Express was good.
It was good. Okay, good. There's just so much to talk about. You were at the Greenspan event last week. We had the IMF go through, and yet currency wars is like green shoots. It's the phrase that keeps on giving. Is it a war? Is it a battle?
Well, I think it's certainly a disagreement. I don't know if we'd call it a war yet. Hopefully it doesn't get to war stage. Certainly, I think if markets really thought there was a currency war going on, I doubt we'd see that VIX slipping below 20 today.
And so that's that cross-asset analysis we want here, looking at the equity market, and you use that right into the foreign exchange market. Let's look at dreaded first chart over here, Bob. Since you've got this chart tattooed to your brain. Real trade-weighted dollar, price-adjusted trade-weighted dollar. Do you just assume dollar weakness below that 2008 and 1995 lows?
Well, there's certainly a potential for that to unfold over the period ahead. A lot will depend on how aggressive the Fed is and how things are going in the rest of the world. But certainly the dollar's at a very competitive level, and certainly not an impediment for U.S. exports, not encouraging U.S. imports. Not clear how much more the dollar can really do in terms of stimulating the economy.
Is this about a weak dollar, or is it about stronger euro, stronger Korean won, stronger Brazilian real?
Well, you've got two different parts of the world there. I think with respect to, if you look at that chart with respect to developed currencies, we are very close to the lows, record lows. If you look at it,
this is important when you take out the major countries.
Right. When you look at it versus emerging market currencies, and the Treasury calls these the OITP, other important trading partner currencies, there the dollar's only about 7% below its average in real terms since the introduction of floating exchange rates back in 1975. So that's where the adjustment process needs to continue. That's what the disagreement is at the G20 this past weekend. And that's really the battle going on between China and the U.S.
Matthew, go back over here and show us this chart again. Over on the left side of the chart, that spike, that is the Plaza Accord. And you could see how we come down the mountain there in the late 1980s, 87. You and I have spoken of the Louvre Accord. That's the one nobody ever talks about. Provide a distinction between the famous Plaza Accord and the less-known Louvre Accord.
Well, the Plaza Accord is really about reversing dollar strength in the early 1980s. I used to have a friend who referred to the dollar strength in the early 80s as the 4 R's, Ronald Reagan and real rates, and those certainly were the big upside pressures on the dollar. The Plaza Accord was an attempt to reverse that and bring the dollar lower. And as you noted, it came down very sharply during that period. The Louvre Accord was basically to say, okay, we've done enough. It's now time to stabilize the dollar. And that took place, and it actually did have some impacts on the dollar.
Let's look at the other side of the story. Asia is watching, and I brought this up, Bob Sinche, because this is dollar renminbi. This is back to the first adjustment in 2005, and you can see the managed curve there. Then we flatline. Are we going to see a mirrored managed curve? Are we going to see 06, 08 yuan appreciation from here?
Well, that would be about another 20% over the next few years. And I think the Chinese would be willing to do that if the global economy were growing rapidly. Remember, this is a period, 2006, 7, and 8, when the global economy was growing in a very robust fashion. China was able to appreciate its exchange rate, yet maintain very strong export growth and very strong growth in their domestic economy. That's where I think the Chinese are a little bit more concerned. And instead, they've decided, I think, to take a little bit of a different approach. You can revalue the effective exchange rate in two ways. One, you can let the exchange rate get stronger. Second, you can let your domestic wages and prices go up, particularly domestic wages go up. And that will make your currency appear as though it's stronger and be less competitive on world markets. Now, the reason I think the Chinese want to go that route is there's pressure on them to increase domestic demand. How do you increase domestic demand? You increase real wages, and they'll spend it and they'll consume it at the same time that they're trying to introduce some of the safety net measures on retirement income and unemployment insurance, etc. So I think the Chinese feel as though they're taking a very good policy path. You know, we've heard about big wage increases in China earlier this year. That will stimulate domestic demand, make them less competitive. The only problem is a very gradual process. Certainly one that's not going to have any impact between now and November 2nd.
Robert Sinche with us of RBS in Stamford, Connecticut, sitting with me here. And we are thrilled to have with us today David Blanchflower, formerly with the Bank of England and at Dartmouth College. And he's now going to tell me not how to pronounce diamond, not how to pronounce Mortensen. Help me out here with your good friend from the London School of Economics.
Go on. Yeah, I will do that. I want to hear you try it again. Try it again for me first.
Pierides.
Pissarides.
Pissarides.
No, Pissarides. Chris Pissarides. He's been a professor at the London School of Economics. I've known him for 30 years. He's actually spent time advising the Central Bank of Cyprus. A good friend of mine, and I know Dale Mortensen pretty well too. Don't know Peter Diamond, but these are people who've done work in the area of labor economics.
I want to talk to you about that later, but just to get right to it quickly, and to both you and Bob Sinche, can we have a healing labor market given this global uncertainty that's out there, Professor Blanchflower?
Well, I don't think we can. I spent a lot of time on Friday going through the labor market data, and it's just not doing the business. We are simply not creating enough jobs. And the worry is not just that it will actually be a jobless recovery, it might even be a job loss recovery. We're simply not seeing job generation coming fast enough. And it's hard to think where it's going to come from in the U.S. and elsewhere.
I'm glad you bring that up.
So really, yeah.
Oh, excuse me, Professor. Bob Sinche, when you look at this effort to jumpstart jobs, the solution's your weak dollar. But that's a big weak dollar, isn't it?
That's a big weak dollar. It's stronger exports, stronger growth overseas. You know, one of the things we discussed Thursday night with Chairman Greenspan is really the housing market in the U.S. too, because before this recession, housing accounted for 7% of employment. Yet construction accounted for over 25%, over 2 million of the job losses during the recession. So until we can get some signs that we've got a bottoming in the construction sector, that's an area where you'll see job growth pick up. And the wages are pretty good there also, but that's out there.
I want to play this for both of you. Earlier this morning, I spoke with Peter Hooper of Deutsche Bank on Bloomberg surveillance, and I asked him whether we should just assume that the dollar will go down in a time of quantitative easing.
When an economy is weak and when it's engaging in monetary expansion, rates go down, and that tends to manifest itself in some weakness in the currency. Certainly, folks at the Fed are going ahead as planned, I would think, and seeing this as one of the key channels of transmission, one of the factors that will get the economy going.
And then Peter Hooper of Deutsche Bank. Professor Blanchflower, when you look at quantitative easing, do we have to do an all-in-one, a more accommodative impulse, or can we get away with a tranched-out effort?
Well, I think we can get away with a tranched-out effort, but if you go back to the comment that was just made, and we've been thinking about currency wars, in some sense you're going to get a decline in the exchange rate if you conduct quantitative easing alone. But the likelihood is that as you start to engage in quantitative easing, as the Fed does, then I'll look in my English hat and I'll look at the Bank of England, and guess what? The Bank of England is going to do quantitative easing as well. So then the danger is, you know, you get into some sort of beggar your neighbor approach. So it's not absolutely clear once you depreciate your currency. If everybody depreciates it together, there's no relative advantage. I think the problem is that this great degree of uncertainty is going to come. The Fed is probably going to do more quantitative easing. It will do it little bit by little bit, partly because we don't understand the transmission mechanism. Still, we don't understand it.
That's very well said. I mean, Bob Sinche, over the weekend, there's just such a mystery. Mohamed El-Erian capturing this in his comments at IMF. There is such a mystery to what's actually going to happen. Do I have that right?
I think that's absolutely the case, and transmission mechanism is a word that's come up here quite a bit in the last few minutes, and that really is the problem. What does QE actually bring on the other side? We think one thing it brings is stronger global economies, because it puts pressure on other economies to deal with the U.S. easing. Interesting comment over the weekend from the governor of the People's Bank of China, saying that this move towards zero interest rates and super accommodative monetary policy is creating enormous policy challenges for emerging market currencies and countries in their monetary policy. They used to want to link their monetary policy to the U.S. Now they're struggling because of U.S. monetary policy and the instability.
And Danny and Bob, let's look at, Rex, bring up chart 3 here, the Brazilian real. I mean, this is a perfect example of how they used to be linked. This goes back, Professor Blanchflower, before Lula and before 2000. And that line going down on the right side of the chart is the Lula success and the success of Brazil. Bob Sinche, is that going to break to new Brazilian real strength?
Well, certainly the pressures are there, and the Brazilians are struggling with this. They can either accommodate with domestic monetary policy, but they've been tightening policy. They can let their currency appreciate, or the third way, which we hope does not become widespread, is actually capital controls, because capital controls in this environment could be similar to trade controls back in the 30s.
Professor Blanchflower, capital controls, I would suggest in your literature, doesn't work all that well, does it?
No, that's right. And my good colleague and friend Doug Irwin's been writing about this. Had a nice op-ed in the Wall Street Journal this week talking about the similarities and the language about protection, capital market controls, the worries about what happened with Smoot-Hawley and so on. Obviously, the worry around the world, following on from the sensible comments just made, that protection. If you can't do it the way you want and you can't persuade the Chinese to do whatever, the danger is that then not only do you put capital market controls in, but you do other kinds of protection to protect jobs, and then we know that trading in the world it tends to fall. So these are really very dangerous. But I think if you look back to the 30s, when you're in these kinds of difficult situations, you start to see bad things occurring. And the worry is what happened in the 30s, it was solved by war. So these are tough times, and the worry always is that there's social unrest, political unrest, and countries fighting with each other because the social situations are bad.
Just quickly, Bob Sinche, to give you the last word here, what's the unexpected you're watching out for right now?
I think the unexpected would be if the dollar really, if the global investors lost confidence in the dollar and it started putting upward pressure on U.S. interest rates. That would really hem in the policy options dramatically.
We're going to have Professor Blanchflower back with us in Tokyo. Should we be on intervention watch this week in Tokyo?
I think so, because Secretary Geithner added a little phrase this weekend, and last week that we didn't hear before. Countries asking not to have intervention by countries whose exchange rates were undervalued. The Japanese yen's pretty strong. Hard to argue it's undervalued. You kind of wonder whether that was a little bit of an out clause for the Japanese.
A signal. It's that nuanced. I mean, every tea leaf and every nuance.
They used to say intervention was not good. Now it's intervention by countries with undervalued exchange rates. A little bit more specific.
Well, Bob Sinche, thank you so much. David Blanchflower is going to come back with us, folks, here. And I want to bring up here, we found the sole remaining copy of The Wage Curve. This book, folks, I believe 1994, was important. Look at that curve. It looks just like a beverage curve, which is from the 1930s. Beverage of the London School of Economics. And then in 1971, a guy named Peter Diamond wrote a paper. Professor Blanchflower, what did Professor Diamond of MIT write on? And then what did Mortensen and Pissarides take on from there?
Well, these are about rigidities that exist in the labor market. Diamond's works, a lot of it's been about optimal taxation and how markets work. The Mortensen-Pissarides work, this is mostly theoretical work. This is about search behavior and how people look for jobs and how unemployment exists even though there are lots of available vacancies out there. So this is important work in unemployment, but it turns out this is a really very hard problem. How do you fix unemployment? And I think we should sort of go there more in a moment. But so these are fundamental building blocks about how you analyze how markets work, how rigidities exist, and how you deal with unemployment. But we have fundamental problems applying the theory to the practice, and I'm happy to talk more about that.
Well, we've got a few more minutes here with you, Professor, but within that, the stopgap for so many, including Alan Greenspan, is education. We want more education. Well, great, that's 10, 20, 30 years out from now. How can you take Peter Diamond and the other new laureates' work and bring it into the immediacy of, say, through 2011?
Well, I think that's a really good question, and I think the answer is you probably can't very well. I mean, in some sense, it says things about the nature of the Nobel Prize in Economics, pretty young prize. This is about building blocks, and the truth is, unlike the prize winners in physics and in chemistry and medicine, these folks haven't actually found anything. They haven't found patterns in the data. It's not absolutely clear that the models that they have actually been writing about are actually true. They haven't really been tested against the data. So if you sit there as in the Bank of England, or you sit there in the Fed as Bernanke, and Diamond being his teacher, it's not absolutely clear that these guys' work will tell you anything about what you should do to fix the problem. And that's the nature of the problems in economics. This is interesting theoretical work, but it probably doesn't help you very much at all to work out what to do about unemployment tomorrow. So it's a really good question of yours, but I think the answer is not much.
In the final minute that we've got with you, Professor, the chart is the wage curve declines. It's inflation-adjusted disposable income per capita, and it's about 34,000. The answer is it's gone flat since 2007. Why have wages gone flat? Do we blame China?
Well, I think, well, in part, I think the way that I would think about it would be two things. Unemployment has been rising, and that scares workers. But actually something I've worked a lot on recently is a thing called the fear of unemployment. It's not just unemployment. It's that if you were to raise your wages, two things might happen. Immigrants could come into the country. The firm could take the work to China or elsewhere, so the fear that you'll be replaced, or even that the firm itself would move to China, is actually what's kept wages constrained. So it's actually about unemployment and the fear of unemployment and the fear that the work can move away that's actually kept wages in check. And the difference, in a sense, between the wage curve work and the prize today is that the wage curve is actually about patterns in the data, whereas the Nobel Prize winners have won things for theoretical work.
We're going to have to leave it there. What a great day to have David Blanchflower on with us. This is Surveillance Midday.